Welcome to Real Estate is Taxing, where we talk about all things real estate tax and break down complex concepts into understandable, entertaining tax topics. My name is Natalie Colati. I'm your host, and I am so excited that you've decided to join me. Hello, everyone, and welcome to this week's episode. Before we get into the tax talk, I would like to start with a little story about a fun thing that happened to me last week. So last week I was speaking at a tax conference. I actually had two conferences almost back to back. I spoke at a conference in Florida. Then I got home. I was home for one day. And then I flew out the next morning to speak at a conference on the Oregon coast. So needless to say, by the time I got there, I was super tuckered out. I hadn't slept well in days. And these were both conferences where there is two instructors, where one person teaches all day. So you just teach 7 hours straight, 7 or 8 hours, and the next day the other person teaches for 7 or 8 hours. So I get to the Oregon coast, which, if you've never been, is beautiful. I grew up in Oregon and hadn't been back in quite a while, so it was fantastic to get back. The coast is 3 hours from the airport. So already tuckered out, land at the Portland airport, get my car. It ended up being a Kia. So I drive this little tiny car all the way over to the coast. I'm exhausted. I get to bed early and I'm like, okay, this is the night. We're catching up. We're going to unwind a little bit, wake up early, teach for 7 hours. Excellent plan. Except at 2 that morning, the fire alarm goes off. Not just the little one in your room that beeps at you, like maybe you burned the toast. The big, loud, jarring bell alarm. So we kind of peek around and the hallway is indeed filled with smoke. So that was pretty concerning. And there's fire trucks. So it's all happening. So at this point, they have evacuated us. And now what you have is like 50 tax professionals standing around in a parking lot in our pajamas at 2 a.m. So we ended up out there for quite a while. It took about an hour and a half, 2 hours for them to kind of figure things out, get things under control, and then clear out the smoke from the building before we could go back in. And I'm just sitting out there and watching the time. And all I could think is, gosh, there's only 5 hours till I teach. There's only 4.5 hours till I teach. And I hear people mumbling. I hear people talking about having to wake up early in the morning, skipping the first class of the morning. And I was like, oh man, I got all the way out here and no one's going to show up to my class because we were all awake in the middle of the night. And then I'm like, do I just start teaching now? Like, can they get credit if I'm just like freestyling a tax class while we're all just in the parking lot for 2 hours anyway? I didn't think it would fly. I don't know. But definitely not something I'd experienced before. They get it all cleared out. What it ended up being was the people who were in a room right across the hall from mine, actually, their air conditioning unit kind of caught fire, exploded, did something. So they ended up having to move those folks to a new room, clearing out all the smoke from the hotel, and then we were allowed back in. But I've got to say, it just felt like I was really overdressed when I went to put on a blazer the next morning to go teach, when all of these folks had seen me in my pajamas like 3 hours earlier. So that was my excitement for the week. And I know it might not sound exciting to everyone, but it was at a tax conference, so that's pretty peak for exciting. But all of that aside, this week, the topic I want to talk to you guys about is something that there is so much misinformation on. It's something that's oversimplified, and it is something that we are seeing a huge uptick in audits. So all of these things combined, there needs to be more solid information out there about this topic. I received some messages asking about it after the last podcast. I teach about this at almost every conference where I speak. Today, we are going to talk about the short-term rental loophole. As a starting point, I hate that it's called a loophole. That, to me, implies we're doing something like shady or kind of skirting the rules, and that's not happening at all. There is just wording in the tax code that allows for a circumstance where short-term rentals can be more preferential tax-wise. That's all it is. If you haven't listened to my No Reps, No Problem episode, I would go back and listen to that. It's going to explain a little bit more for kind of a foundation. But just as a recap, normally long-term rentals are passive income. What this means is the losses related to them are subject to certain limitations. Basically, if your income is under $100,000, you can only use $25,000 a year of passive losses. If it's over 100, you start to lose out on being able to use those losses against your W-2 income or your business income. Once your income is above $150,000, you can no longer use any of your passive losses for the year against your other income types. So it won't reduce your W-2 or your business income or anything else, no matter how big the loss is. So all that said, a lot of investors get really frustrated with their long-term rentals because if you put in a ton of money, if you have a bad year, whatever the case, and you generate a large loss, you may not be able to receive a benefit from it in that specific year, right? The losses never go away. It carries forward. It can offset other passive income. But if you spent a ton on your rentals and you are thinking, well, at least this will pay off at tax time, it may not if your income is over $150,000. With that frustration point is why people are now so excited about this short-term rental loophole. Where this strategy stems from is Code Section 469. That is what defines what is passive, what isn't, and all of the guidelines around it. In that code section, there are two ideas, two key pieces that are going to relate to today's episode. The first one says that for an activity to be non-passive, the taxpayer needs to materially participate in it. Material participation is just a level of involvement. There are 7 different tests to use to prove that you've reached that level. You only need to meet one of the 7. The most common ones relate to how many hours you've put in. Also in that code section, it defines what a passive rental is. It goes on to talk about the various types of rentals and then some kind of unique circumstances where they may not be passive. That is where it notes that an exception to a rental being passive is if the average guest stay is 7 days or less. So in a nutshell, if you have a rental property where the average length of stay is 7 days or less, and if you are materially participating in it, it is by definition non-passive. So there's nothing questionable to that. It is clear in the code. So that's the starting point to this loophole. We can take a rental property, meet certain criteria, have it be non-passive, and what that means is that you are no longer subject to that passive loss limit. Now, no matter how high your income is, you can use the losses generated from your qualifying short-term rental. So this is huge, right? This is incredibly exciting for people, and it gets better. The next piece to this is that you can pair this with a cost segregation study. This is typically the other part of the loophole. What a cost segregation study does is it allows an engineer to look over your property, and instead of depreciating just one building across 27.5 or 39 years, what a study does is allows them to break out all of the pieces of a building. And it's actually the more correct way to report depreciation. You're not just buying one specific thing. A building is made up of multiple things. So what the study does is breaks all of those things apart. The reason this matters is that on average, about 30% of the value of a building that you buy is of shorter-lived assets. Things that we don't expect to actually last that entire life, that 27.5 or 39-year life. Things like appliances, flooring, certain electrical components, window coverings, all kinds of things that are going to have a life of either 5, 7, or 15 years instead. This allows you to have a larger write-off per year. So with this study, you're front-loading a lot of your depreciation. You're taking it in those first years on those shorter-lived assets. The second part to that is anything with a life of 20 years or less qualifies for bonus depreciation. This is something that basically says you can deduct a big chunk of your purchase all in the year it's put in service. It applies to anything with a life of 20 years or less, and the amount you could take is going to depend on the year that that asset was put in service. So from 2017 through 2022, it was 100%. So if you put your rental in service during those years, now you do a cost segregation this year, you would still get 100%. It's based on the year it goes in service. For 2023, that dropped down to 80%, so you could write off 80% of the purchase price that first year. For 2024, it dropped to 60%, and it's set to continue phasing out, but my guess is that that will change. So the components we have to this strategy so far are you make sure your average guest stay is 7 days or less, you materially participate in the property, you do a cost segregation study, which allows you to take a chunk of the cost of the building, move it all into shorter lives, giving you a higher annual write-off, and then you can accelerate that even farther by using bonus depreciation that will let you then take a huge chunk of that expense in the very first year. So all of these things combined give us a really unique opportunity to strategically create a large amount of deductible loss in a year when it's needed. So that can be tremendous for tax planning. When it comes to this short-term rental loophole, it's an annual test. So for that calculation, for the average guest stay, that is looked at on a calendar year basis. It is annual. For the test of seeing if you materially participated, that is based on that year. It's an annual test. This allows a short-term rental to be somewhat of a chameleon. We can shift the way it is taxed by intentionally passing or failing these tests. The way we figure out the average guest stay is it's going to take all of the days it was rented during the year and divide it by the number of independent separate guests that stayed at the property. So it's just an average. So you can have some that are more than 7 days, as long as you have some that are less and the average stay is under 7. A common mistake I see with this is that because this is an annual test, if you have a long-term rental that you are converting to short-term, that long-term stay is going to be part of your average. That's going to throw your average much higher than 7 days. So if you have a long-term rental that you are considering switching to short-term, you are going to want to do that as close to the start of the year as possible. The way the code is written, we need to prove an average of 7 days or less. You need 2 or more stays. This was recently reaffirmed through a ruling that is exactly what they said. We cannot figure out an average of something unless we have at least 2. So if you buy a rental property that you are going to put in service as a short-term rental, you need to both put the property in service and have at least 2 fair market value independent stays before the end of the year. These are the 2 biggest mistakes I see, or things that people kind of didn't expect to happen when it comes to putting a short-term rental in service and getting to use this strategy. One of the pushback items that I will hear from people is that they don't want to manage a short-term rental. It's more work, right? They can often be more work. There's more turnover. You have to deal with furnishing. You're dealing with a lot more people throughout the year. And if you want to materially participate, that is going to be close to impossible to do if you have property management. What this means in real-world terms is that you need to manage that short-term rental for the year you are wanting to implement this strategy. Additionally, you are going to have to be mindful of how much time is spent on it by anyone else. I mentioned earlier there are 7 different rules for material participation. The 2 most common rules that we see taxpayers use are at least 500 hours during the year on the activity. If you don't hit that 500 hours, the other rule that is commonly used says that you have spent at least 100 hours, but it was also more time than anyone else. So what this means is that not only do you have to track your time and be able to prove you spent 100 hours, you also have to track the time of your house cleaner. If you have a co-host, you now need to track the time of anyone who is spending a substantial amount of time on your property so that you can prove they are not spending more time than you are. I actually just heard about someone who is going through an audit specifically on this topic, and that is the hang-up. The taxpayer is able to prove they spent at least 100 hours. But on a short-term rental, if you have guests switching weekly, your cleaner spends quite a bit of time at the property. So they are having a very hard time proving that the cleaner did not spend more time on the property than the taxpayer did, and they didn't track the cleaner's time. So they're now going through and trying to reconstruct that time using, the camera dates on it and the keypad login and trying to reconstruct it and hopefully prove that the taxpayer had more time. I actually spent a few hours on a phone call with a friend of mine who is also a real estate tax strategist. And what we are both seeing is an increase in audits related to this, and that it tends to be related to proving the time and proving those cost segregations. So it doesn't make the strategy any riskier. As long as you're doing it correctly, you will be good. So all of that said, it doesn't make this a risky strategy. It doesn't make it something you shouldn't consider. It just means that what you're hearing on social media, where all you are told is buy a short-term rental, average day of 7 days, and materially participate, you can take all your losses. There's more to it, and now that it's being looked at a little more closely, you want to make sure you are crossing your T's and dotting your I's. The checklist of things you are going to want to do to make sure that you do not get it handed to you in an audit, you are going to want to make sure that you can prove an average guest stay of 7 days or less by having at least 2 qualifying stays before the end of the year. If you have your friends stay there and they're not paying you for it, the other big thing is proving your material participation. That means you are going to want to track all of your time spent on that property and ideally prove that you spent at least 500 hours on it during the year. If you really can't hit 500 hours, you are going to want to also track the time of anyone else who is working on or involved with that property. Another caveat to this is with material participation, you cannot include investor hours. So the time you spend looking at financials, writing checks, kind of the in-office, unrelated to the direct day-to-day of the property, those don't count. So really make sure that you are documenting all of this accurately and on a continuous ongoing basis, because I will say after reading hundreds of court cases, any case related to hours, whether that's material participation or real estate professional, there's a couple things where it always gets thrown out in court. The first one is not having a log. If you have no log whatsoever, you can't prove anything, that's obviously going to shoot you in the foot. The second most common thing is if you have a log, but it seems wrong or like you falsified or that it's just not super believable. It's kind of like once they've determined one part of it isn't reliable, the whole rest is thrown out. So you want to make sure that you not only have a log, but that it is sensible and accurate and ongoing. You want to make sure that if you are going to say that you qualify to write off $100,000, that you are willing to take the extra 15 minutes a month to prove that. So it is a great strategy. It is a fantastic way to create a large loss in a specified year. A lot of people will by default do a cost segregation study and qualify the property as non-passive in the year they acquire it. And that may be the best year to do it. It's the easiest from a reporting standpoint because when you do a cost segregation study, we can just set up depreciation with those amounts. However, from a tax planning standpoint, it might not always be what's best for you. If the year you put that property in service and it qualifies for a non-passive short-term rental, if in that year your income is much lower than you know it's going to be the next year, you might want to wait till the following year to do a cost segregation study. And then in that following year, you will have to materially participate and have that average guest day of 7 days or less. If you can have a much larger benefit from the same amount of deductible loss, then you might want to save it for that year. When you do a cost segregation study, you can do it at any point. It does not have to be during the year the property is placed in service. You can do it in any later year. The longer it's been, the less benefit it has because you're chipping away at that depreciation already. So if it's 20 years in, you don't have a lot left. But if it's year 2 or year 3, absolutely look at which of those years will that large amount of loss most benefit you. it might not be the current year. If you wait and do it in a later year, for taxes, you need to include Form 3115 with your tax return. The reason we can pick the year we take the loss is that if you are changing depreciation, you don't go back and amend. So if you put a property in service in 2020 and this year you do a cost segregation, you don't go back and amend those past few years' tax returns. You file Form 3115 with your current year return, and you are allowed to take the loss adjustment, that depreciation adjustment for the expense, in the current year. So even if the property was put in service several years ago, you can do a cost segregation study now, and you would get the write-off on the current year tax return. The deadline for doing a cost segregation study and having it included on a tax return is just the filing deadline for that tax year. So you would just need to complete the study by April 15th or October 15th if you file an extension. So there's a great planning opportunity here to choose when you use that loss and to figure out if the ease of doing it first year is actually worth it or if it's worth it to save it for a later year. Again, you don't go back and amend. We can't go backwards and amend depreciation. The only time that that's an option is if only 1 year has been filed. So for example, if you're listening to this right now and you already filed your 2023 taxes and you had a new property in 2023, if you did a cost segregation study at this point, you would have the choice of either amending 2023 and changing the depreciation because it's only been 1 year. The way depreciation works is if you have reported a method, if you've sort of said, this is how we're doing it, the way you establish that method is by doing it 2 or more years. You've established a pattern, you've set that this is what you're doing, you didn't change your mind. If it's only been 1 year, they don't consider that set yet. So if you had a new rental in 2023, you could go back and amend 23 to add the cost segregation study to that year if it would have more benefit to you. Otherwise, for years 2024 and forward, you could do a cost segregation study in any of those years. You would take the expense adjustment in the current year's tax return. You would file 3115, and you would have what's called a 481A adjustment on Schedule E. So you have a lot of planning opportunity with short-term rentals. This is why hearing about the short-term rental loophole has become incredibly popular, and it's a fantastic tax strategy. I love this, and I implement this with a lot of my clients. All I'm here to tell you is make sure you're doing it correctly. You just don't want to kind of skirt the edges and do the high-risk things because it's not worth it, right? Why open up an audit for no reason? Like I mentioned earlier, because it's a year-to-year test, even if you're someone who's sitting there thinking, this sounds great, Natalie, but I don't have time to manage a property. I don't want to deal with that. All of my properties are fully managed. I'm hands-off. That is what I have always been taught to do as an investor, is it's not worth my time. I understand that. It's a year-to-year test. If you had the potential to take a $100,000 loss on your taxes this year, do you think you could deal with managing a property for 1 month? Could you try to buy a property to use as a short-term rental for only the month of December of this year, making sure that you put in the hours, making sure that the average stay, there's at least 2 that are 7 days or less? At the end of the year, that test resets. So even if you buy your property late in the year, as long as you can meet that 100 hours and more time than anyone else, or that 500 hours, and you can prove 2 or more stays with an average of 7 days or less, you can have that rental qualified as non-passive for that year. Then January 1st, if you want to change it over to a long-term rental, or you want to hand it off to be fully property managed where you're not involved anymore, that's fine. This strategy allows us to take a decent amount of loss, typically in a single year. That's what we're doing. If you don't need that large loss in 1 year, so you are not using bonus depreciation, you just say, you know what? I do like the idea of taking 30% of the cost of this building and having it across these first 5, 7, and 15 years. I never keep properties longer than 10 years, so that really lines up. That works well for me. That's going to get me to an amount of tax I'm happy with. Then you would need to keep it non-passive for all of those years. And then if you switch it back to passive the next year, there's no clawback. So if it is non-passive and you take a huge loss in 1 year, and literally the next year, a month later, you say, actually, we're going to sign a year-long lease. This will be a passive rental again. You don't have to pay anything back. There's no reprimand. There's no provision that says, oh, well, since you didn't keep it short-term for at least this amount of time, it doesn't qualify. It's an annual test. The last item that I will touch on related to short-term rentals is the depreciable life. So this catches a lot of people off guard. Like I said, we get to depreciate property at either 27 and a half years if it's residential or 39 years if it's non-residential. Now, tax terms are almost always going to be different than lending terms. So a lot of people are going to look at a single family house and say that is residential all day long. For taxes, it may or may not be. If you have a single family house, but you are using it to run a business out of, you run a hair salon in the whole property, that is a commercial use of the property for tax purposes. Because a short-term rental does not meet the defining factor of a rental property, it falls out of the standard depreciation life for being a residential rental. A residential rental would be 27 and a half years. And again, there's an exception in the code. In 168, there's a note that this excludes properties that are basically used on a transient basis. So this is going to apply to hotels and motels and things like that. And transient basis is typically looked at as under 30 days. So if you are meeting this 7-day or less criteria, your property is definitely being used on a transient basis, and your depreciable life is going to be 39 years. If you have a valid short-term rental, it is treated as a commercial property for depreciation because we have pulled it out of the defining factors for being residential. That being said, there's even more unique opportunity here for depreciation because some of renovations, depending on when you buy, if it's in service, what kind of the timing of how this happens, you might have qualified improvement property. That is also 15 years, which also allows bonus depreciation. If you have a property that switches between long-term and short-term, your depreciable life is going to switch with it. If you had it as a long-term rental for years and you were depreciating it over 27 and a half years, but for this year you switch it to short-term, you will only change the life to 39 years from this point forward. Something that gets asked pretty often is if I am changing from long-term to short-term, do I need to file Form 3115? Natalie, you just told me if we try to change depreciation after 2 or more years, I have to file this form. That is true if what is changing is the method of depreciation. If it's the same activity, but we want to change the way we are depreciating it, then we have to file a 3115. If the actual activity is what changes, the method of depreciation is allowed to change with it. Similarly, if you have a primary home that you're living in, you don't get to depreciate it. It's personal, not a business asset, no depreciation. However, as soon as you switch it over to being a rental property, now you do get to depreciate it because now it is a qualifying business asset. The activity is what changes, so the amount or how you depreciate it changes to match up. So when we switch from a long-term rental that has 27 and a half years to a short-term that has 39, or vice versa, the life is allowed to change with it. You just change the depreciable life from that point forward and you recast it. You do not need a 3115 if you are switching back and forth from long-term to short-term rental. And one quick mention on midterm rental. There is another circumstance where rentals can be non-passive in kind of the same area of the code, and that is if the average guest stay is 30 days or less, and you provide significant personal services. Now, here's the hang-up. Significant personal services is part of Code 469, which lets us say passive or non-passive. However, the definition of significant personal services is almost identical to the definition of substantial services, which is what determines if a property is subject to self-employment tax. So if you are doing a 30-day or less rental and you are providing significant personal services / substantial services, there's almost exact overlap. These are going to be services to improve the experience of the guest during their stay. So think of a hotel. This does not include services provided in between stays. Cleaning in between guests does not subject a property to self-employment tax. Providing items does not subject a property to self-employment tax. Providing supplies on site, if you provide some coffee pods or toilet paper, that does not subject a property to self-employment tax. The only thing that is going to convert your property from being non-passive, which is still reported on Schedule E, most short-term rentals go on Schedule E, 98% I would say, non-passive on Schedule E. The only time it moves over to Schedule C is if it is subject to self-employment tax, and the only time a rental is subject to that self-employment tax is if you are providing those substantial services or those significant personal services. These are going to be services during the guest's stay, not things outside of it. So if you have a maid who comes in and cleans the unit every day while the guest is staying there, if you offer room service where you'll deliver food to their room, if you offer a hotel shuttle where you will pick them up from the airport and bring them to your property, if you provide any kind of lessons on site, you do fishing lessons or hiking or swimming or anything like that. If a verb is occurring, it has to be a verb during the time the guest is renting the property. It has to be something of a pretty substantial value, and it has to be occurring while the guest is there and to increase their experience. So this is another one of those really common misconception points, and this is where I see it being taught incorrectly on the professional side. There's a fair amount of tax educators who get mixed up on this and want you to put the short-term rentals on Schedule C because they believe providing anything is a service, and that's not the case. If it is not happening while the guest is legally entitled to the unit, if it is not increasing their experience while they are staying in the unit, if you are not doing something with a verb while that unit is rented, it still stays on Schedule E and it is still non-passive. Very rarely do I see a rental with services at a high enough level to move to Schedule C and be subject to self-employment tax. The same thing falls into place with the 30-day or less exception to being passive. If you're saying my property is rented for 30 days or less and I'm providing significant personal services, so it is non-passive and I can use my losses, that is true, but you will now almost always have to move it to Schedule C and also pay self-employment tax on any income. So be cautious there because it's a little bit of a double-edged sword. Now, one of the last notes that I'll kind of leave off on with this is what is the downside to having the rental on Schedule C if that's what you've been doing. I've heard this from a lot of people. We didn't know. We were putting it on Schedule C, but it turns out it shouldn't have been there. It's just non-passive, and non-passive is not the same as subject to self-employment tax. And only activities that are subject to self-employment tax go on Schedule C. There's a couple exceptions. They're specifically stated. This isn't one of them. So if a property has been on C incorrectly, if you had income on that property and you were paying self-employment tax, you didn't have to. That wasn't qualified. You did not need to pay that extra 15.3% tax. The other bigger concern I have is because this was taught so heavily for a few years, because there was this misconception that it should go on C most of the time, if it didn't really qualify to be on Schedule C, if what you just had was a non-passive short-term rental that should stay on Schedule E, you weren't doing any kind of substantial services, if you use that Schedule C income to fund a retirement account, it wasn't valid. You are only allowed to fund retirement accounts with earned income. And rentals, even if non-passive, are not earned income. It has to be income paid out of income that is subject to payroll tax, self-employment tax. So if you incorrectly had a short-term rental on Schedule C, take a look at this. Review your prior returns and see what the big picture impact was. Did you pay tax for no reason? Did you fund a retirement account when it really didn't qualify for you to fund it? And talk to your tax professional about sort of the risks of what has happened, or the potential benefits of amending to fix it, or the risks of not amending to fix it, and find out what the correct steps would be to correct it and move it over to Schedule E if that is the case. So that is everything I have for you guys. I know that this is a lot of information. There is, like I said, a lot of nuance around this loophole that is often oversimplified. And I just want to make sure that even if you get this great tax advantage today, it doesn't end up coming back to bite you 4 or 5 years from now. So that's my summary for you guys. I hope that you found this helpful. One final run through of what you shouldn't be doing for your short-term rental and what this loophole means. If you rent the property for an average stay of 7 days or less, and if you materially participate, it becomes non-passive. This means losses it creates can be deducted against your other income types, and you don't have that standard limit. The only limit you can run into is an excess business loss limit. Step 2 is that you do a cost segregation study, which pushes a large amount of your depreciation expense into those first years. And that gives you a much higher write-off in each of those years. You can take this even farther by applying bonus depreciation, which will give you a large amount in the first year, between 100 and 60%, depending on what year the property went into service. And then kind of the last note to this is make sure you are dotting your I's and crossing your T's. Track your hours, track your cleaner's hours, make sure you're not fluffing up your hours or using investment hours, and make sure that if you are doing a cost segregation study, unless you absolutely have to, pay for a full study. Go to an actual cost segregation firm. Typically, I recommend to avoid the DIY version whenever possible. A lot less accurate, you're going to get a lower result, and they're a much higher audit risk. We've even seen them disallowed. So that is my recap for you guys. Fantastic tax strategy. Absolutely worth looking at. Make sure you look at it with some foresight. Look at the next few years, when to implement it, how it's going to benefit you, the time you transition, and make sure that you are putting everything in place so that if this is ever looked at, if you ever have to prove that you absolutely deserved that $100,000 expense that you got to write off this year, that they have no reason to question it or try to take it away. So I hope you guys found this helpful. If you have any additional questions, you can find me on social media. I'm RE Tax Strategist on Instagram, and you can find me at Natalie Colati on Facebook. Additionally, please like, share, and subscribe, and reach out with any other topics that you want to hear on a future episode. Thanks for listening, and I will chat with you guys next week.